Welcome back to the channel where maths always comes before emotion. आजकल एक बड़ा ही पॉपुलर नैरेटिव चल रहा है इन द फाइनेंशियल सोशल मीडिया एंड दैट इज as the Western AI trade slows down, Indian IT will automatically benefit. So today we are going to discuss if discounted Indian IT stocks are a massive value trap or is it actually a good buying opportunity.
Most of these stocks that had hit a 52-week low in yesterday's trading session, Infosys, TCS, Wipro, LTIMindtree, and after having fallen 50% from their peak, these stocks are rebounding again. Is it a dead cat bounce?
किंतु सच्चाई तो ये है कि प्राइस एक्शन जो है वो कहानियों पे नहीं चलता. So let's look at the math and find out if it is a solid recovery theory या फिर retail investors आलू से सोना निकालने का प्लान बना रहे हैं. Before we look at the numbers, let's understand कि ये नया नैरेटिव आखिर है क्या, क्योंकि हम सब हैं ही बड़े ज्ञानी और हमेशा ट्राई करते हैं कि हाउ टू आउटस्मार्ट द मार्केट. और हर बार की तरह रिटेल इन्वेस्टर्स का लॉजिक इस बार भी बहुत सिंपल है. इफ बिग कॉर्पोरेशंस स्टॉप पोरिंग मनी इनटू एक्सपेंसिव एआई एक्सपेरिमेंट, that money must automatically flow back into traditional bread and butter IT contracts. मतलब AI का खर्चा बंद तो इंडियन IT का चालू. Sounds logical, right? So let's test it. सबसे पहले let's find out why AI spends are slowing down or being paused. इसके तीन बड़े reasons हैं. Number one is the unit economics of AI are fundamentally broken.
Because AI maybe is becoming too expensive to scale.
Using OpenClaw these days is like driving a Ferrari.
It takes $1 billion to train a model that gets sold as a $20 subscription. And right now, corporate employees are mostly using it to summarize emails they were not going to read anyways. On top of that, running massive models requires staggering compute and data costs. Reason two is CapEx funding is being trimmed. AI customers have burnt billions of dollars and now they are aggressively slashing non-essential tech spends to protect their own profit margin.
Do you think this is the quarter when these hyperscalers get on their earnings call, Dan, and they cut back a little bit on CapEx because they realize investors don't want to see all this aggressive CapEx every single quarter?
और तीसरा सबसे बड़ा रीजन है ROI. The ROI is return on investment. AI companies are realizing that moving AI from a cool lab experiment to a revenue-generating corporate tool is a painfully slow process.
We were zeroed in on capital expenditures, and that was the be-all and the end-all. Are investors starting to look deeper and at different data sets to assess the health of what's going on?
I think we talked about in an earlier episode, is the high failure rate of AI initiatives.
So yes, for the three reasons above, AI trade is cooling off. But the reality is that companies have simply locked their wallets. AI adopters have not really discarded the technology. They are actively identifying and optimizing new ways to use it. So now that we briefly understand why AI trade is weakening, let's find out the ground reality of the Nifty IT index and their balance sheets. The Nifty IT index has crashed over 31% in past 6 months. Legacy giants like TCS and Infosys are trading near 52-week lows, while yearly growth guidance across the sector has plateaued at a flat 3 to 4%. Popular belief is that because the index has been holding a base level for last 1 month or two, we have bottomed out. Although many experts warn against it. लेकिन एक रिटेल इन्वेस्टर के लिए उम्मीद और लालच बड़ा ही डेडली कॉम्बिनेशन है. एक रिटेल इन्वेस्टर को और क्या चाहिए? AI trade is getting weaker and Nifty is at its bottom. 1 + 1 is equal to full profit. But if that is your investment logic, you are completely ignoring one massive structural shift. और वो सच ये है कि शेयर के मुंह में खून लग गया है. So let me explain what I mean. Global clients have realized that they can use baseline AI tools internally to do the low-level coding and testing they used to outsource. And सबसे important, they are not renewing legacy contracts at old prices. They are demanding heavy discounts on any upcoming renewals, which is a permanent blow to earnings.
For decades, India's IT industry sold time, hours of coding, days of development, weeks of maintenance, and it billed clients accordingly. That model is now changing, faster than most people realize. According to a Mint report, India's largest IT services companies are getting more work contracts based on fixed prices and outcomes. This marks a fundamental shift away from the traditional time and material billing model.
And if they want to build high value software, they don't hire a third party vendor anymore. They build it inside their own GCCs, the Global Capability Centers. So the reality is that the enterprise dollar is still coming to India, but it is mostly bypassing the IT stocks in your portfolio. तो इस situation का कड़वा सच ये है कि buying a stock because it looks cheap relative to its historical valuation is an incredibly expensive way to learn a hard lesson. So our assessment is that based on math and analysis, Indian IT is not out of the woods yet. Financial social media के बहकावे में मत आओ, अपना दिमाग लगाओ. So that was it for now. एक reality check comments में जरूर कर लेना. Tell me honestly, are you holding these IT stocks because you genuinely see a new growth catalyst, or you are just averaging down hoping to break even? Drop your sector exposure below and let's see where this community stands. So thank you all for listening so far, but there is one more important question. If traditional IT is a structural value trap, then which is the sector to invest in? So I have answered that question in my deeper research analysis. And let me tell you how good my analysis is. This year in Jan, I told people that IT is a trap. So those of you who listen to me are sitting in 30% of saved profit. So for the investment thesis of 2026, मैंने एक comprehensive research paper बनाया, but that paper is available only to the paid members on this channel. So for the less than the cost of a decent dinner, you can immediately unlock our 2026 asset allocation model designed to spot these value traps before they hit your capital. The portfolio insulation roadmap to defend your core savings during major sector deratings, and private community Q&A to decode macro shifts before they hit the retail market. So hit that like and subscribe if you agree with me about IT, and if you would like to promote this channel. Thank you for tuning in and thank you for your time.